These three option trading strategies that I'm about to walk you through are perfect if you're a new or beginner level trader and want something that is easy to remember and even easier to execute. The first example is known as a covered call. And for this, we're going to use a combination of TradingView here, looking at the Disney stock, and our interactive brokers portfolio as well, Trader Workstation, to show you the money that you can get paid for executing a covered call trade. What a covered call is a contract that you agree to. You sell the contract and you agree to potentially have your shares of Disney, in this case, called away if the stock hits a certain price. For example, let's say we have Disney here and we have 100 shares in our account ready. That's why it's called covered, because you already own the shares. When you have the shares here, let's say we bought them in here at this area right here, right at this big candlestick at the 107 level. That's where we bought the shares, let's say in this example. So they're already up, okay? From 107 to 109, you're up roughly $2 per share. Let's say we have 100 shares in the account. So 100 shares, right? Purchase at this level right there. We're in good shape right now. What we can then do is say, hey, we think Disney's a really good stock, and we're not sure where the price is going to go right now. So, to make a little bit more of the cash, the moolah, what we can do is sell a covered call at a level we don't think the price of Disney is going to get to in the next 25, 30 days. Looking at the chart right now, we can see this big candle over here, this big red candle. It's probably not going to get there. It's actually trending downwards if we zoom in. So let's say we set the price around 114. Let's say 115 is our kind of our price line up here. Let's go up to the top and go and draw it in at 115. And let's go and say at this level here that's in blue, we want to sell a covered call contract at 115. So when we come into our interactive brokers layout here, what we can see that we have in their options chain for Disney, right? We have Disney selected here. We have the March 15th, 2024 calls and puts, 24 days till expiration, okay? At that 115 level, we can see there's a bid ask there of 0.82 and 0.86. So let's call it 0.84 right in the middle there. And in this example, you would get paid $84. And the math works out like this, that 0.84, 0.84, you multiply that again by 100, because every options contract is made up of 100 shares. And that's where you get your $84 for the contract. Meaning, if Disney's price stays below our 115 level up here within the next 24 days, we get to keep $84 of cold hard cash. It's great. And the worst case scenario in this example, if Disney's price does creep up and passes above this 115 level right here, right? What happens if it gets up and it kind of goes up like this and crosses and goes above here? Well, we would then just sell our shares for that agreed upon 115 strike that we just looked at in interactive brokers here at 115. Meaning, in this example, we would have bought in the shares at 107, right? Stay with me here. If we buy shares at 107, okay, and we sell them at 115, that's an $8 difference in share price. That means you just made $800 in capital gains. Plus, you got paid, remember, $84 to sell that covered call contract. So now, boom, what you're doing is just juicing up your returns to a total of $884. That's some good living right there. That's some good eating. Worst case scenario, right? That's $884. If this doesn't work out, if the price of Disney decides to keep moving on down, even if it goes below your purchase price of 107, you still keep that $84 that you got paid to sell this covered call CC contract. So the pros here is that it's easy to execute, which is great. You just have to buy 100 shares of any stock. If you have some already in your account, you can do this on pretty much any stock you own 100 shares of. There is limited downside risk because when the price goes down, you just actually capture this cash for the covered call a little bit quicker, and you can sell more covered calls after you close out the initial position. And you're getting paid cash for a really low time investment. Like you make this trade, we put this on in the hopper, right? We come in here to interactive brokers, we would go 86, we'd go want to sell the contract, quantity of one, put our limit order in and submit it, and we'd be done. Like that'd be it. And you'd be in the hopper. And then you just sit back and wait and collect the $84 that you see down here in the orders section. Once that gets filled, you're off to the races. Cons, you do need to have capital to buy those initial 100 shares, right? There's a little bit of capital to be able to do that. And the shares can get called away. So the one negative, I guess, the real kind of con is that if you were to do this, and let's say you did that 115, great. And the next day, let's say Disney comes out with the next movie called Moana 3 or 2 or whatever number they're on, and it's absolute blockbuster and it kills, and the stock just decides to go like this and goes to the moon. Well, yeah, right. Like you could have just held the shares without selling a covered call and sold for 130 up at this level. So you are capping your gain, but you're still making that $84 in premium down here for selling the contract and selling at 115. So you are capturing a good chunk of the change, you're just not capturing the full movement up. So just think of it as kind of a way to limit reward while also limiting risk and kind of just juicing up your returns if the stock does end up going back down this way. The next example we're going to go into is looking at a naked put. When you sell a put option, what happens is you're giving someone else the right to sell shares to you, okay? And how a put option works when you sell a put or you sell a naked put, what you want to do is pick a level, let's say, on a stock that you want to own, by the way. You want to pick a level that you don't think the price is going to drop below. So example here for Zoom, we've had a couple of recent lows. We're trying to make newer highs, and we have this kind of bottom area here on October of 2023 around $58. So let's put a line right there just to mimic that and mark that at 58. So we have an idea of where the stock would maybe catch and bounce on a technical level. So if we keep 58 in mind for our actual number here, we're going to target for our put. Remember, we don't want the stock to go below this. So we want to make this maybe a little bit more of a buffer down here on this end. Let's go down to 55, let's say, all the way down here. That's a lot of buffer. We'll see what it looks like in our option chain in a second and say, hey, maybe this is our key level down here. We're going to sell our put at this level and take on that risk there of the stock not getting below that. So again, when you do this contract, what you're doing is you're getting paid basically to sell insurance. If the stock doesn't go below your 55 or the number that we pick here, you get paid cash, right? If it does go below there, you have to buy 100 shares at your strike price. Let's say it's 55. Let's go look in the chart in market brokers and see what you're going to get paid and the price you're going to have to buy the shares at. That's the main risk. You have to buy some shares, okay? But it's an easy one to execute. And if we go in here and look at Zoom, we said 55, right? We're going to go out in time and get it in the options chain here. We're going to go out in time, click, and we're going to go out. Again, 24 days is roughly where we're going to head for this one. And at the $55 strike, okay, Zoom's currently trading at 61.36. At the $55 strike, meaning you'd have to buy the shares for $55 per share, which is a $6 discount from where they're trading at today. You'd get paid between $86 and $92. So let's call it $89, okay? $89 to sell this contract and sell this naked put. And if for whatever reason, Zoom's price does drop all the way down here to 55 and it ends up right here and then kind of goes back up, you get to keep this $89. You buy your 100 shares. So it's going to cost you 55 times 100, so $5,500. That's the one downside or the con that you have to think about. It's a little bit capital intensive here at the start, but if you can keep that in mind and get paid $89 to do so, you just bought stock at $55 today. That was trading at 61 up here on the chart. If we move up higher, it's been at 73. It's been at 83, 90. Like it's been at crazy high levels before this. So if you think that this stock is going to kind of rebound, it may be a really good buy here down at 55. And you may get paid this $89 right here and then be able to hold on to the stock long term and wait for that recovery, buy it here, get paid to buy it there, wait for the recovery and go turn around and sell it over here. Or like we talked about in the first part of this video, sell a covered call on the way up and get paid to sell the call option, have the shares called away. But again, positives, you get a nice payday for a little bit of risk. You could turn around today and just buy the shares on the market for $61, right? And that's pretty risky in itself, just buying shares straight up. If they go down, you lose money. At least this way, if the share price goes down, it has to go all the way down to $55 before you buy the shares. So there's some risk protection in that form. But if you end up buying the shares at 55, it's no different than buying at 61 with the currently trading, except you got a discount. You have to buy them at 55. So it's cheaper for you and you got paid to do so. Again, the drawdown here is that you have to have capital in your account to do this. And when you put one of these trades on, you have an opportunity cost when you're making this trade to go ahead and get it in the hopper versus doing something else in your account. And this is one that I love to trade. I love doing naked puts. I love doing covered calls. Both of them are kind of like the wheel strategy. If you want to know more about these, I have a options trading course for beginners. It's currently on with a 50% discount at Options Academy. I'll put the link in the description for this video. There is a ton of content, a ton of great videos and walkthroughs showing you how options work, option pricing in the Greeks. Check that out if you want to know more about options. Again, on sale for 50% off today, right now, currently. Now, the third thing we can do is buy leaps. And for that, we're going to go to Apple. And Apple's a really big stock, really big name. And what a leap is, it's just a long expiration call option, meaning that we're going to buy a call option. And normally, when you buy a call, right, we talked about selling calls, covered calls. We talked about selling puts. Now we're going to do some buying of the contract. So we're the ones in the control. We're the captains now, as it said. When you buy a leap option, okay, leap down here, a leap option or leaps, you want the price to go up when you buy a call that's long dated expiration. I'll show you what that means in a second. You want the price to go up. And generally you do it on a stock that is a kind of big household name that's been kind of beaten down a little bit, but has a long history of kind of overperforming or just great growth, great track record. I picked Apple here because it has been beaten down from its all-time highs around $200 per share. And what this involves is that you buy this call option. If the stock price goes up over time, you make money. The more it goes up, the more money you make. If it stays kind of flat, you don't make money. But the good thing is that it's so far out in time, the expiration date, like we're talking about going not just like a month or two now, we're talking about going like a year or more over like this area right here, expiration, or right here. So there's a lot of time for this to kind of move around and work. And as long as it goes up to a certain level, which I'll show you in a second, you're going to make money and just you have to wait it out. And it's a long-term trade where time is more on your side, given that you pick the right stock and has a good track record moving forward. So an example here would be Apple here. And we go out in our options expiration dates here. Instead of going 24 days, we're going to go out super far away. Again, we're going to go March 21st, 2025. So 395 days away. And what we want to do here, we want to have some capital that we have to pay to open up this trade. But what we're going to do here is hopefully capture some upside. And if we do this and do this right, we're going to come in here at this 160 strike price, let's say. And what this is going to tell us here is it's between 36.05 and 36.55. So let's say 36.30. It's going to cost us $3,630 to open up this trade. We would put it in the hopper and buy. But when we go into our advanced tab here, look at our performance, it's going to tell us over here that we need to hit a break-even price of 198.56. Okay, so that's where the price of Apple needs to go to in order for us to start making some money on the trade. We have a probability of 43%, which is fairly good when you're buying options. Okay, but this is the key number, 198.56. We go back to the chart and plot that 198.56. Okay, we're right about there, this blue line. So what has to happen, Apple's got to get up and above that line within the next 390 days. So by which day here? Where are we going? We're going like down here, all the way over here. We got to hit it by then. We have a long way to go until then. And given what Apple's kind of been doing lately, long term, if you zoom out a little bit, you can see kind of the growth of Apple. It kind of goes in these little lulls and kind of goes up, goes in the lull, goes up, goes in the up, goes up, goes up, kind of back and forth and down. And there are periods where it has declined, not going to lie, but generally speaking, it's a pretty big stock. It's fairly confident it's going to get back to its all-time highs. Eventually, doing it this way gives us the opportunity for it to get there within the 390-day period. You would do this, set this trade up, and then just sit back and wait. And the closer it gets to that 198 again, you're going to start seeing some profit. And then if it crosses over that, that's when you're really in the money and you're going to start making some good bang for your buck right here, crossing over that key level. The drawbacks for this strategy are that you have to have the capital, like we said, 30 630 to get going. But again, it is cheaper than buying 100 shares of Apple right now at 181. That would cost you 18K to do that. So this trade lets you control 100 shares in one contract for the price of a fraction, almost 5 times less than, or more than 5 times less than just having to buy 100 shares outright. So your capital and your risk are kind of mitigated that way in this trade, which is a good thing. You just have to have the capital and you have to be willing to tie it up for a long period of time, but hopefully you get the direction right and you bank on historically the stock market being an upward moving mechanism where the stocks that are kind of good quality companies will eventually recover, break through those lines, get over your profit break even area and start making you some cash. You go close the trade off when that happens. And you, my friend, are off to the races with your options trading strategies for a beginner. If you did get some value in this video here today, I would invite you to please subscribe to the channel for more. Thank you for watching this video. It means a heck of a lot to me, and I will catch you on the next one.